On September 16, 1992, the financial world watched in astonishment as a dramatic and unexpected event unfolded. The British pound sterling, once a symbol of global economic might and stability, buckled under the pressure of a full-blown currency crisis, sending shockwaves through the financial markets. This day, forever etched in British financial history as Black Wednesday, marked a dramatic turning point for the UK economy and its place on the world stage. The repercussions were felt far and wide, altering the course of economic policy. The events of that day exposed the vulnerabilities of the exchange rate mechanism, a system designed to stabilize European currencies, but which ultimately proved to be flawed and unsustainable under the strain of market pressures. It revealed the limits of a government's ability to defy market forces, no matter how strong their resolve or how well-intentioned their policies might be. The pound's collapse sent shockwaves through the British economy, triggering a sharp recession and forcing the government to make the difficult decision to withdraw from the ERM, a move that had significant long-term implications. Businesses large and small grappled with the sudden uncertainty, facing challenges that many had never anticipated and struggling to stay afloat in the turbulent economic waters. Ordinary citizens watched in dismay as their savings and pensions were eroded by the pound's plummeting value, leading to widespread financial insecurity and anxiety. The political fallout was equally swift and brutal, with the Conservative government already facing mounting criticism over its handling of the economy, suffering a severe blow to its credibility and public image. The crisis sparked intense political debates and public outcry. Black Wednesday served as a stark reminder of the interconnected nature of global financial markets and the speed at which seemingly robust economies could be brought to their knees by unforeseen events. The crisis exposed the inherent risks of fixed exchange rate systems, particularly in the face of speculative attacks and divergent economic fundamentals, highlighting the need for more flexible and adaptive economic policies. For Britain, Black Wednesday marked the end of an era, forcing a fundamental reassessment of its economic and monetary policies. The country had to rethink its approach to managing its currency and economy. The events of that day continue to resonate today, serving as a cautionary tale for policymakers and a reminder of the enduring power of market forces. Financial experts and historians still analyze the crisis to understand its lessons. The lessons learned from Black Wednesday have shaped the UK's approach to economic management in the decades since, influencing everything from its decision to remain outside the Eurozone to its adoption of a more flexible exchange rate regime. These changes have had lasting impacts on the country's economic stability and policy direction. Britain's decision to join the European exchange rate mechanism in 1990 was driven by a desire for economic stability and a belief that aligning the pound with stronger European currencies would help tame inflation and foster economic growth. The idea was that by pegging the pound to these more stable currencies, Britain could benefit from the economic discipline and stability that characterized the European monetary system. The late 1980s had been a turbulent period for the British economy, marked by high inflation, volatile exchange rates, and a widening trade deficit. These economic challenges created a sense of urgency within the government to find a solution. The Conservative government, led by Prime Minister Margaret Thatcher, saw joining the ERM as a way to restore confidence in the pound and rein in inflation, which had become a persistent problem. Thatcher's administration believed that the ERM could provide the necessary framework to stabilise the economy. The ERM, established in 1979, aimed to reduce exchange rate volatility and achieve monetary stability within the European economic community. It was designed to create a zone of monetary stability in Europe, which was seen as essential for economic growth and integration. By joining the ERM, Britain committed to maintaining the pound's value within a narrow band against other member currencies, primarily the German Deutschmark. This commitment required the Bank of England to intervene in the currency markets to keep the pound within the agreed-upon range. This fixed exchange rate system was seen by its proponents as a way to promote trade, attract foreign investment, and impose fiscal discipline on member states. The hope was that a stable currency would make Britain a more attractive destination for investors. The decision to join the ERM was not without its critics. Many were concerned about the potential loss of monetary sovereignty and the risks associated with tying the pound to the Deutschmark. Opponents, including some within Thatcher's own Conservative Party, argued that tying the pound to the Deutschmark would cede control of British monetary policy to the Bundesbank, Germany's central bank, and limit the government's ability to respond to domestic economic shocks. They feared that Britain would be at the mercy of decisions made in Frankfurt rather than London. They warned that the ERM's fixed exchange rates could create imbalances and stifle growth if member countries' economies were not sufficiently aligned. Critics pointed out that economic conditions in Germany and Britain were often quite different, making a one-size-fits-all policy problematic. Despite these concerns, the allure of stability and the perceived benefits of closer European integration proved too strong to resist. The government believed that the long-term benefits would outweigh the short-term risks and challenges. Britain entered the ERM in October 1990 at a rate of 2.95 Deutschmarks to the pound, a decision that would have far-reaching consequences for the British economy and set the stage for the dramatic events of Black Wednesday 2 years later. This period would become a defining moment in Britain's economic history, illustrating the complexities and challenges of maintaining fixed exchange rates in a dynamic global economy. The British economy entered the 1990s facing a confluence of challenges that would test its resilience and adaptability. These challenges would ultimately undermine its membership in the ERM, a system designed to stabilize European currencies. This instability paved the way for the infamous Black Wednesday crisis, a day that would be etched in the annals of British financial history. Despite the government's efforts to control inflation, it remained stubbornly high. This persistent inflation was fueled by a combination of factors, including strong consumer demand, rising oil prices, and a weak pound, which made imports more expensive. The government's decision to raise interest rates to combat inflation further dampened economic activity. This policy, while aimed at curbing inflation, inadvertently pushed the country into a recession by 1990, exacerbating the economic hardship faced by many citizens. The ERM's fixed exchange rate system, designed to foster stability among European currencies, instead became a straitjacket for the struggling British economy. The rigidity of this system left little room for the flexibility needed to address the unique economic challenges Britain faced. With the pound pegged to the Deutschmark, British interest rates were effectively dictated by the Bundesbank. The German central bank was pursuing a tight monetary policy to control inflation in a newly reunified Germany, which had its own set of economic challenges. This left the British government with limited room to manoeuvre. Unable to lower interest rates to stimulate its own sluggish economy, the government found itself in a bind, struggling to find effective solutions. Adding to the economic woes, Britain's trade deficit continued to widen. This widening deficit reflected a loss of competitiveness in key sectors, making it increasingly difficult for British businesses to compete on the global stage. The combination of high inflation, high interest rates and a fixed exchange rate made British exports more expensive and imports cheaper. This further exacerbated the trade imbalance, putting additional strain on the economy. The government's attempts to address these problems through fiscal policy, such as tax increases, proved largely ineffective. These measures failed to curb inflation or stimulate growth, leaving the economy in a precarious state. As the economic situation deteriorated, doubts grew about the sustainability of Britain's membership in the ERM. The fixed exchange rate system, once seen as a pillar of stability, now appeared to be a significant liability. The pound came under increasing pressure from currency speculators who believed it was overvalued. These speculators bet that the government would eventually be forced to devalue the currency, adding to the financial turmoil. The stage was set for a dramatic showdown between the British government, determined to defend the pound's fixed exchange rate, and market forces, which were betting against its ability to hold the line. This clash would ultimately lead to one of the most significant financial crises in modern British history. Black Wednesday, September 16, 1992, began like any other day in the bustling trading floors of London's financial district. But beneath the veneer of normalcy, tensions were running high. The pound sterling, already under pressure for weeks, was facing a renewed wave of speculative attacks. Currency traders, sensing blood in the water, were betting heavily against the pound, convinced that the British government would be unable to maintain its commitment to the ERM's fixed exchange rate. As the day wore on, the selling pressure on the pound intensified, pushing its value perilously close to the lower limit of its permitted trading band within the ERM. The Bank of England, in a desperate attempt to prop up the currency, intervened in the markets, buying up pounds with its foreign currency reserves. However, these interventions proved to be woefully insufficient to stem the tide. Despite the Bank of England's efforts, the pound continued its downward spiral, forcing the government to take even more drastic measures. Interest rates were hiked twice in a single day, first to 10% and then to a staggering 15%, in a futile attempt to attract investors and shore up the currency. The move, while this government's resolve, backfired spectacularly, sending shockwaves through the economy and further undermining confidence in the pound. By the end of the day, the writing was on the wall. The government, having exhausted its options and facing a humiliating defeat, was forced to admit defeat. Finance Minister Norman Lamont announced Britain's withdrawal from the ERM, effectively acknowledging that the government could no longer defend the pound's fixed exchange rate. The news sent the pound into freefall, marking a dramatic end to its brief and turbulent stint within the ERM.